It's been a volatile week for the critical mineral sector, and after back-to-back sell-offs in Lithium Americas, Energy Fuels, and American Battery Technology, it's tempting to focus only on the pain in the share prices. But sometimes, it's important to take a step back and ask what the bigger picture really looks like. Because what's unfolding right now isn't just a correction, it's part of a much larger story about how the United States is trying to secure its independence in the global race for critical minerals. The question this weekend isn't just why the stocks fell. It's whether the United States can still win the critical minerals race, and what this week's chaos might actually reveal about that battle. Let's start with what happened. The trigger was the Department of Energy's decision to cancel a $57 million grant to American Battery Technology for its lithium hydroxide project. The company says it plans to appeal, but the damage was immediate. The cancellation sent shockwaves through the market because it challenged one of the key assumptions investors had made about the energy transition, that government support was unconditional. Until now, federal funding had been treated like a guarantee, a safety net that made every lithium or rare earth project seem less risky. But the DOE's decision sent a different message. Government support is no longer automatic. Projects have to meet performance standards, timelines, and accountability measures. For investors, that realization hit hard. In the short term, it spooked the market. Stocks like LAC, UUUU, and ABAT were sold off aggressively. But in the long term, it might actually be a necessary turning point, because building a stable, credible supply chain for critical minerals requires discipline as much as ambition. Lithium Americas is a good example of this paradox. It's arguably the most strategically important lithium play in the country, with the Thacker Pass project in Nevada backed by a $2.26 billion DOE loan and a 5% US government equity stake. That's a remarkable level of involvement. And yet, even with that kind of support, the stock fell sharply this week. Why? Because the market suddenly realized that government partnership isn't a free pass, it's a test. The DOE's involvement means progress will be scrutinized closely. Every delay, every missed milestone, every regulatory question will now attract attention. But at the same time, that scrutiny creates credibility. It forces execution, it forces transparency, and over time, that's what separates real operators from speculative hype. Energy Fuels sits at the other end of the spectrum. It's less reliant on DOE loans or grants, and its exposure is broader, from uranium to rare earths. It wasn't hit as hard as the lithium names this week, but it still suffered because the whole sector is being repriced for risk. Investors are rethinking what government-backed really means. And then there's American Battery Technology, which has gone from being a rising star to a cautionary tale in just a few days. Losing a federal grant of that size is more than symbolic, it's operationally significant. But it's also part of a pattern we've seen before in emerging industries, a harsh reminder that innovation needs to survive not just through funding, but through resilience and adaptability. Taken together, these three companies capture the full spectrum of the challenge the United States faces. On one hand, it wants to reduce dependence on China for the materials that power the modern economy, lithium for batteries, uranium for energy, and rare earths for defense technology. On the other, it's realizing that building a domestic supply chain from scratch is messy, expensive, and politically complex. And that brings us to the second layer of the story, geopolitics. Because while this week's stock movements may seem isolated, they're happening in a global context defined by growing tension between Washington and Beijing. China still dominates the processing of lithium, rare earths, and other critical minerals. It controls not just the raw materials but the refining and conversion stages that turn those minerals into usable components. When China hints at tightening export controls, it sends shockwaves through global markets. Prices spike, supply chains wobble, and Western governments scramble to respond. We've seen this before, with semiconductors, with solar panels, and now with minerals. The United States knows it can't afford to remain dependent forever. But decoupling from China isn't simple. It requires not just mining resources at home but building the entire processing and manufacturing ecosystem that comes after. That's where companies like LAC, UUUU, and ABAT come in. They're the early movers in that effort, the frontline experiments in creating an American minerals industry that doesn't rely on imports. And as this week showed, that process is volatile. Some will fail. Others will stumble and recover. But every step forward, even the messy ones, contributes to a larger pattern of progress. The DOE's decision to pull funding from ABAT may look harsh, but it's also a sign that the US government is starting to treat this industry with the seriousness it deserves. It's moving from symbolic investment to performance-based partnership. That's uncomfortable in the short term, but it's what separates vision from execution. For investors, that means the landscape is changing. The market will no longer reward hype and potential alone. It will reward proof, cash flow, partnerships, milestones, and real progress. Companies that can show they can operate within this new accountability-driven framework will emerge stronger. In that sense, this week wasn't the beginning of the end, it was the end of the beginning. This is the shakeout phase of the American minerals renaissance. It's the moment where government enthusiasm meets industrial reality. It's the first time investors are being forced to separate what's real from what's just narrative. It's also a moment where patience becomes an edge. The easy money phase of the story, where everything connected to battery metals went up simply because of the theme, is over. The next phase will be slower, more selective, and ultimately more sustainable. Let's think about what that means going forward. First, it means that volatility is here to stay. These are long-cycle projects, and they move at the speed of regulation, permitting, and construction, not at the speed of daily trading. That's uncomfortable for traders, but for long-term investors, it creates opportunity. Second, it means that government involvement will remain central, but it will evolve. We're moving toward a model where the DOE acts less like a passive grant provider and more like a strategic investor. That's actually a positive development for credible operators. If anything, it validates the idea that the US is serious about building a real, performance-driven supply chain. Third, it means that companies with strong private partnerships, like Lithium Americas' relationship with General Motors, will have an edge. Because at the end of the day, it's private capital and execution expertise that will determine which projects get built. And finally, it means that the real race is just beginning. China's dominance isn't going away overnight, but every headline about export controls or policy friction only reinforces why this push for independence matters. The US might move slowly, but it moves deliberately, and when it commits to an industrial goal, it tends to follow through. In 5 years, the companies that survive this phase, the ones that meet milestones, manage funding responsibly, and communicate clearly, could be the foundations of a trillion-dollar industry. The shakeout we're witnessing now will likely be remembered as the growing pains of that transformation. So can the United States still win the critical minerals race? Yes, but not through easy money or hype cycles. It will win through execution, accountability, and time. It will win through companies that can balance ambition with discipline. The short-term volatility we've seen in stocks like LAC, ABAT, and UUUU isn't a sign of failure, it's a sign that the system is maturing. The government is learning to invest more strategically. The market is learning to value credibility over concept. And the companies that adapt fastest will emerge as the real winners of this new industrial era. For now, the sector will remain choppy. The headlines will swing from optimism to doubt and back again. But beneath the noise, something real is being built, a domestic supply chain for the minerals that power the modern world. And that's why, despite the fear and the selling, this week may go down as one of the most important in the story so far. Because it marked the moment when the US stopped talking about mineral independence and started demanding it.